Hello everyone, John AG here. Welcome back to my channel, Aurex. If you haven't yet, subscribe to my channel. In this channel, you will find the real information, real market updates that everyone cannot tell you. So please subscribe to this channel and love you all of my subscribers for your support. And please watch this video till the very end because YouTube will not push my videos to more people. What if I told you that the silence in the markets right now is the most dangerous sound you could possibly hear? We are conditioned to fear the crash. We are taught to panic when the red candles cascade down our screens and the financial news anchors are shouting about trillions of dollars evaporating in a single afternoon. But that is not how the wealth of the middle class is truly destroyed. The sudden crash is just the opening act. The real devastation, the systematic harvesting of generational wealth, happens in the quiet, bleeding aftermath. It happens exactly where we are right now, in the final days of May 2026, staring down a market anomaly that has fundamentally broken the spirits of millions around the globe. Today, we are dissecting the illusion of safety. We are tearing back the curtain on the precious metals market, the broader macroeconomic landscape, and the brutal, unforgiving reality of what global commodities are screaming at us while the rest of the world is distracted. If you hold physical gold, if you are invested in silver, or if you simply hold fiat currency in a bank account hoping it will retain its purchasing power, you cannot afford to look away from this screen. What we are witnessing on the charts today is not a simple technical breather. It is a highly engineered psychological trap known as the bear flag, and it is designed to separate you from your hard assets just before the greatest wealth transfer of our lifetime accelerates. Let me ask you a question. How does it feel to look at your portfolio right now? For the past few months, the gold market has been hovering around the $4,440 mark. Silver is limping along, fighting a desperate daily battle to hold the $74 line. After the relentless, heart-stopping, visceral volatility we witnessed at the beginning of the year, this sideways, downward drifting consolidation might feel like a relief to the untrained eye. It feels like the bleeding has stopped. It feels like the market has finally found a floor and is simply catching its breath, gathering strength for the next massive leap upward. But this is the ultimate deception. In the ruthless world of institutional trading, a bear flag is a siren in the dark. It is a technical formation that occurs after a violent vertical drop. The price then consolidates, drifting slightly upward or moving completely sideways, forming a rectangular flag on the chart. To the retail investor, it looks like a recovery, but to the algorithmic trading systems running out of Wall Street and the City of London, a bear flag is merely a pause to reload short positions. It is a temporary ceasefire initiated by the market makers before the next trapdoor is violently swung open. When we pull up the weekly timeframes for both gold and silver, the technical data paints an incredibly grim, undeniable picture. We are watching massive descending triangles form in real time. The volume-weighted average price and the crucial 20-day simple moving average are bearing down from above like an anvil. The momentum indicators have gone completely flat in negative territory. The institutional liquidity, the very lifeblood required to sustain a true bull market, is actively draining from the exchanges. To understand why the ultimate safe haven assets, the oldest forms of money known to human civilization, are flashing warning signs in a world that is objectively fracturing, we have to look backward. We must reopen the wounds of January 2026. We have to confront the historic crush that traumatized the retail investor class and reshape the entire derivatives landscape. Think back to late January. The atmosphere was absolutely electric. The global economy was gripped by a speculative frenzy that rivaled the great gold rushes of history. Gold had surged to a breathtaking, history-making all-time high of $5,595 an ounce. Silver, riding the coattails of industrial panic, severe supply deficits, and retail euphoria, had gone completely parabolic, touching an unimaginable $130 per ounce in the overnight trading sessions. Everywhere you looked, people sincerely believed the US dollar was dying a sudden death. Middle-class families across the globe, terrified by the silent theft of inflation and the relentless, unstoppable march of sovereign fiscal deficits, were frantically converting their life savings into physical bullion. Local coin shops were stripped bare. Wait times for delivery extended into months. And then there was the speculative capital, massive, highly leveraged inflows from the East, driving prices into the absolute stratosphere. It felt invincible. It felt as though the global financial system was resetting before our very eyes, returning to a hard money standard by sheer force of public demand. And then, the invisible hand of the macro machine struck. In a matter of 72 hours, the music abruptly stopped and the exits were bolted shut. Do you remember the morning of January 30th? Because financial historians will write entire textbooks about that specific trading session. In a single, devastating day, gold plummeted more than 12%. It was the largest single-day percentage wipeout since the engineered crashes of the early 1980s. But silver, Silver was an absolute bloodbath. It lost over 35% of its value in a single rotation of the Earth. Within 3 days, silver was down 41% from its peak, and gold had shed a quarter of its entire value. Fortunes were vaporized into the digital ether. Generational wealth, heavily leveraged on the long side by investors who believed they were riding a one-way ticket to financial freedom, was margin called out of existence. I have read the emails and heard the stories of people who lost their homes. I know of families torn apart by the stress of that drop. When we talk about these charts, we are never just talking about numbers on a screen. We are talking about human lives, raw hopes, and futures that were systematically dismantled. What triggered that historic meltdown? I can promise you it was not a sudden magical influx of physical supply. Nobody suddenly unearthed the hidden mountain of gold in the Nevada desert. No, the crash was a perfectly orchestrated, surgically precise collision of macroeconomic policy and institutional self-preservation. It began with a political catalyst that sent shockwaves through the bond markets. The announcement that the Federal Reserve would be placed under profoundly hawkish leadership sent a crystal-clear message to the world. The era of accommodating inflation was over, and the United States was preparing to defend the dollar at any cost, even if it meant breaking the global economy. The moment that shift in monetary regime was priced in, the US dollar index spiked violently. And as we discuss constantly on this channel, when the dollar flexes its geopolitical muscle, paper gold is immediately forced to its knees. But the dollar spike was only the spark. The gasoline was poured directly onto the fire by the commodity exchanges themselves. As gold and silver hit those dizzying record highs, threatening to break the massive short positions held by bullion banks, the exchanges stepped in and ruthlessly altered the rules of the game overnight. They weaponized the margin requirements. Gold margins were hiked from 6% to 8%, and silver margins were violently yanked from 11% to 15% with zero warning. If you are a retail investor buying physical coins to bury in your backyard, margin requirements mean absolutely nothing to you. But if you are a massive hedge fund, a family office, or a speculative trading desk holding billions of dollars in leveraged paper contracts, a sudden margin hike is an absolute death sentence. It forces you to either inject millions of dollars of fresh capital into your account immediately, or your broker will liquidate your positions at market price without your permission. Faced with that impossible choice, they liquidated. The initial wave of selling triggered automated stop losses, which in turn triggered more selling, creating a self-feeding, cascading avalanche of forced liquidations. The paper market completely collapsed under its own artificial weight, dragging the physical spot price down into the abyss with it. It was a structural squeeze, engineered from the top down to flush out excess leverage and protect the clearinghouses. And it worked with terrifying perfection. Now we find ourselves in late May 2026. The smoke is cleared, but the psychological wreckage remains. Gold is trapped at $4,440. Silver is pinned at $74. The bear flags are waving ominously. But when we pull the camera back and examine the broader commodity complex, a deeply unsettling, almost terrifying paradox emerges. Look at the world around you. According to the latest global commodity outlooks, essential raw material prices are forecast to rise across the board this year. Energy prices are projected to surge dramatically, driven by the ongoing, escalating conflicts in the Middle East and severe, seemingly permanent disruptions in the Strait of Hormuz. Crude oil is marching steadily higher, threatening to break the back of the global consumer. Fertilizer prices recently jumped by double digits due to those exact same supply chain strangulations, guaranteeing that the cost of food will continue to skyrocket by harvest season. Do you see the massive, glaring disconnect here? Energy is skyrocketing. Agricultural production costs are spiraling out of control. The basic, fundamental cost of human survival is compounding daily. Geopolitically, the world is fracturing into opposing trade blocs, with de-dollarization accelerating at a pace no one thought possible a decade ago. The US federal debt has completely detached from reality, sitting at astronomical levels compared to gross domestic product, requiring over $1 trillion a year just to service the interest. We have the absolute perfect textbook recipe for a classic stagflationary crisis, a nightmare scenario where economic growth completely stagnates, yet the cost of living continues to explode upwards. In every single economic textbook ever published, this is the precise environment where precious metals should be launching into the stratosphere, leaving all other asset classes in the dust. Yet gold and silver remain stubbornly stuck in a bearish consolidation, threatening to break down even further. What is this contradiction actually telling us about the inner workings of the financial system? It is screaming two deeply uncomfortable truths that most financial advisors refuse to acknowledge. First, the algorithmic market still blindly trusts the central banks. Despite the horrific, unsustainable fiscal deficits, the bond market and the computer programs that execute 80% of daily trading volume still believe that the Federal Reserve will successfully engineer demand destruction. They believe the central banks will keep liquidity tight enough to choke out inflation, even if it causes a severe recession. When liquidity is systematically sucked out of the global financial system to defend a currency, everything gets sold. There are no exceptions. In a true structural liquidity crisis, correlation between all asset classes goes directly to 1. Desperate funds do not sell what they want to sell, they sell what they can sell to raise cash. And right now, the algorithms are aggressively positioning for a deflationary shock where cash, specifically the US dollar, remains the undisputed king of the hill, regardless of how much debt backs it. Second, we are witnessing the absolute peak of the paper market's control over physical reality. There is a profound systemic dislocation between the actual physical scarcity of commodities and the paper derivative contracts that dictate their price. Let us deeply examine silver to understand this dynamic. Silver is currently entering its 5th consecutive year of a massive structural supply deficit. The world is quite literally running out of the above-ground physical silver required to meet the exploding demands of the future. The artificial intelligence boom that has taken over the tech sector requires massive, energy-intensive data center build-outs, all of which require incredibly complex electronics, which in turn require immense quantities of silver for conductivity and thermal management. At the same time, the global mandate for green energy has pushed photovoltaic solar panel production into overdrive, consuming hundreds of millions of ounces of silver annually. This is not investment silver sitting in a vault. This is industrial silver, vanishing into technological sinks, destroyed on a microscopic level, never to be recovered or recycled. Despite this undeniable physical reality, the price was allowed to collapse 35% in a single day and is now languishing under a bear flag. Why? Because the paper derivatives market, the thousands of highly leveraged futures contracts traded daily in New York and London, entirely dictates the spot price. The bear flag we are analyzing today is merely a reflection of paper market exhaustion, not physical market reality. It is a glaring symptom of a heavily manipulated, deeply fragile financial plumbing system that uses unlimited paper contracts to suppress the price of finite physical elements. As a narrator of these economic times, I cannot just throw technical indicators and supply-demand deficits at you without addressing the profound human cost of what we are enduring. Every single time the price of oil spikes because of geopolitical chess moves, a family somewhere has to make the agonizing choice between heating their home and putting food on the table. Every time central bankers decide to manipulate interest rates to defend a fiat currency backed by unprecedented debt, small business owners are choked off from the vital credit they need to keep their doors open and their employees paid. What we are living through right now is not a natural market cycle. It is a period of historic, engineered wealth transfer, carefully disguised as necessary monetary policy. When you look at the chart of gold, you are not just looking at the fluctuating price of a shiny yellow metal. You are looking at a real-time, global electrocardiogram of humanity's trust in fiat currency and government competence. The incredible, euphoric run-up we saw in January was the deafening sound of millions of people screaming that they no longer trusted the system. And the brutal, unforgiving smackdown that followed? That was the system striking back with overwhelming force. It was the financial empire reminding the retail investor exactly who controls the levers of power and who owns the printing press. The bear flags we see today represent the deliberate exhaustion of the middle class. The people are tired. They are financially battered. Many bought into the market at the absolute top, driven by a legitimate existential fear of inflation, and they were mercilessly punished for their foresight by the paper markets. Now, as the price bleeds sideways day after day, week after week, a dangerous apathy is setting in. And let me tell you, as someone who has studied the deep mechanics of these markets for years, apathy is the exact weapon the smart money relies on. They want you to get bored. They want you to get frustrated. They want you to stare at this descending triangle on the charts, panic about a potential flush down to $3,600, and willingly hand your physical ounces back to the dealers at a massive loss. Because while the retail investor is paralyzed by fear and apathy, do you know who is absolutely not selling right now? Who is quietly, methodically accumulating every ounce of physical metal they can get their hands on while the paper price remains suppressed? The apex predators of the global financial system, the central banks themselves. While the retail market is terrified by the technical bear flags, sovereign nations are backing up the truck. Throughout the last several years, central banks have been buying physical gold at a record-shattering pace, absorbing thousands of tons annually. Even now, in the midst of 2026's massive price volatility and macroeconomic uncertainty, the world's most powerful financial institutions project that central bank accumulation will only accelerate. Recent internal surveys reveal that nearly every major central bank outside of the Western hegemony plans to significantly increase their gold reserves over the next 12 months. Let the magnitude of that reality sink in for a moment. The very institutions that hold the power to print endless quantities of fiat currency are frantically exchanging their own paper for physical, unencumbered gold. They are actively preparing for a multipolar world order. They are building an impenetrable hedge against the ultimate weaponization of the US dollar. They understand a fundamental truth that retail investors often forget. While a hawkish Federal Reserve might successfully prop up the dollar for the next few quarters, the long-term mathematical reality of sovereign debt is absolutely inescapable. You simply cannot sustain multi-trillion-dollar fiscal deficits indefinitely without eventually debasing the underlying currency to inflate the debt away. It is not a theory, it is a mathematical certainty that has played out in every major empire throughout human history. These central banks do not trade on margin. They do not care about the Chicago Mercantile Exchange changing its margin requirements. They do not use automated stop losses, and they do not panic when the weekly chart prints a red candle. They are playing a generational game of chess, aggressively acquiring the ultimate Tier 1 reserve asset while the retail public is being systematically shaken out by short-term paper volatility. This is the paramount lesson of the current market setup. The bear flag on your screen is a short-term, paper-driven illusion. If the price of gold completely breaks down below its key support at $4,440 and flushes downward, the institutions will not panic. They will view it as a historic, generational discount, and they will clear the market of physical supply. So, how do we navigate this storm? How do you, the individual investor, survive the intense psychological warfare of the 2026 commodity markets without becoming collateral damage in a game played by billionaires and central bankers? First and foremost, you must ruthlessly separate your emotions from the daily charts. If you hold physical precious metals, you must deeply internalize that they are not a get-rich-quick tech stock. They are the ultimate form of financial insurance against systemic failure. You do not sell your homeowner's insurance policy just because your house did not catch on fire this month. You hold that policy because the structural integrity of the entire neighborhood is severely compromised, and you know the sparks are flying. Second, you must pay intense attention to the fundamental physical realities rather than the paper manipulations. Watch the supply chain bottlenecks. Watch the energy markets. The paper market can suppress the price of a commodity like silver for years, but it cannot print physical metal to put into an AI server or a solar panel. Eventually, the physical bottleneck will become so severe that it overwhelms the paper derivatives, forcing a true, violent price discovery that will leave the short sellers entirely exposed. Third, monitor the macro triggers that will inevitably force the Federal Reserve's hand. If the underlying U.S. economy begins to show critical structural cracks, if unemployment spikes violently, or if the sovereign bond market begins to seize up due to lack of liquidity, the central bank will be forced to abandon its inflation fight. The absolute moment they pivot, the moment they signal to the world that they will prioritize bailing out the economy over defending the purchasing power of the dollar, this technical bear flag will be instantly obliterated. The trap will spring in the opposite direction, and the next, infinitely more powerful leg of the bull market will commence. But until that moment arrives, you must remain incredibly vigilant. You must be resilient. You must survive the chop of the sideways market. The market is ultimately a device designed to transfer money from the impatient to the patient. Never in our lifetimes has that reality been more crucial to understand than it is right now, looking at the manipulated, deeply coiled commodity markets of 2026. We are standing at a profound precipice in global economic history. The old rules that governed the financial system for the last 40 years are breaking down in real time. The geopolitical chessboard is being violently rearranged, accompanied by the aggressive repricing of energy and the relentless hoarding of hard assets by sovereign nations. The bear flags in gold and silver are merely telling us that the market is currently caught in a brutal tug of war between short-term liquidity tightening and long-term unavoidable systemic inflation. The paper market is currently winning the battle, driving prices into a consolidation trap designed to break your resolve. But physical reality always, inevitably, wins the war. A digital contract promising an ounce of silver is not an ounce of silver when the supply chains break. A sovereign bond yielding a few percentage points is entirely useless if the currency it is denominated in loses a massive fraction of its purchasing power in the real economy. You must take it upon yourselves to seek out the truth. You must step outside the deafening noise of the mainstream financial media, which exists only to report what has already happened, never to prepare you for what is coming. You must analyze the raw data, understand the hidden motivations of the institutional players, and take decisive action to protect your own financial sovereignty. I started Aurex because I was sick of seeing the financial industry treat everyday, hardworking people like acceptable collateral damage. I witnessed firsthand how algorithms and opaque institutions harvest the wealth of the middle class through engineered volatility, fear tactics, and asymmetric information. My absolute mission is to level that playing field for you, to give you the historical context, the macroeconomic reality, and the unvarnished truth so you can make the decisions necessary to protect your family's future in an increasingly hostile economic environment. The road ahead for the remainder of 2026 is going to be incredibly turbulent. The bear flags we analyzed today might fully play out. We could easily see further agonizing downside in the weeks to come as summer liquidity dries up and the algorithms press their advantage. But do not let the short-term manipulation blind you to the long-term reality. Hold the line. Be smart with your capital. Do not use extreme leverage in a market specifically designed to margin call you into oblivion. Own tangible physical assets outside of the digital matrix. Intimately understand your risk profile and prepare yourself for the long game. Thank you so much for your time today. If you found deep value in this analysis, please hit that like button right now. It is genuinely the only way we can fight the algorithm and ensure this vital, unfiltered information reaches the people who desperately need to hear it before it is too late. Share this video with your friends, your family, and anyone you know who is struggling to make sense of this chaotic, rapidly changing economy. Remember, if you haven't yet, subscribe to my channel. In this channel, you will find the real information, real market updates that everyone cannot tell you. So please subscribe to this channel and love you all of my subscribers for your support. And please watch this video till the very end, which you just did, because YouTube will not push my videos to more people without your engagement. I am John AG. This is Aurex. Stay safe, stay profoundly vigilant, and I will see you in the next update.